Is the index universal life policy what's best for your portfolio? In today's video, we're going to dive deep into the mathematics behind index universal life to help you make an objective decision on whether or not it's something that you should include in your portfolio. I want to make this video as objective as possible. I have a bias. I personally don't like index universal life in individuals' portfolios unless it's in a exception scenario. But far too many people are buying them as a result of what I think is clever sales tactics and marketing. But I'd rather have you discover that on your own versus me just preaching about it and telling you about it. Let's look at the math and let's determine for ourselves whether or not this is a good fit for our portfolio. The calculator that we're going to use to do this math is called Truth Concepts. Each and every one of you can have access to Truth Concepts software for 30 days free trial. You can check my math, you can do it along with me, and you can verify for this for yourself with your individual policies illustration data, with your individual policies math to determine whether or not this is a good fit for you and whether it makes sense to do it or not. You can access that at truthconcepts.com. First off, we have to set the ground rules. We need to understand who are the players at play, what are they being compared against, and can we make apples to apples comparison versus apples to oranges comparison. So let's start with just whole life insurance. I know that's not the topic of the video, but we're going to start with whole life insurance. Whole life insurance is a cash vehicle. Whole life insurance is not an investment, and it should never be compared against investment. If you're comparing whole life insurance to an equities account or to a real estate deal or into an investment opportunity, you're making the wrong comparison. You're comparing an apple to an orange. Is what you should be comparing whole life insurance to is your checking account, your savings account, your money market, your CDs, and maybe your bond. But that's it. It should be viewed in the line of safe, liquid cash. Index universal life policies should also be viewed in that state. They should not be viewed as an investment, but oftentimes they're sold as an investment alternative. And when you sell it as an investment alternative, you're telling people that you're going to get investment-like results inside of the index universal life policy. And so today, the comparison that we need to make is, should we be investing in equities or investment with our dollars, or should we be putting them into an index universal life because sold as a replacement or better alternative to things like a 401k, tax-free income, going to provide retirement income. It's sold as a retirement replacement vehicle, which is very much in alignment with what equities and investments. Now, please understand, I'm not trying to provide any investment advice today. I am just providing education so we can make a comparison between those two things. All right, to start off, we're going to use Truth Concepts accumulation calculator. We're going to look over a 40-year period. We're going to try and make this super simple to understand. We're going to have a 40-year-old. Instead of having a lot of complexity by adding premium every year, we're just going to look at $100,000 in. What did that perform over that 40 years? And do a side-by-side comparison of this was my dollar amount as if I had just taken those investable dollars and invested them into investment. We're going to be using the S&P 500 with dividends as our standard right now versus taking those investable dollars and driving them into an IUL policy instead, because IUL policies are sold as a 401k replacement, as a tax-free retirement solution, as a retirement income solution, which is usually what you utilize for assets like real estate or the equities or any of the other investable things that you can invest in. They're telling you in the way that they sell it that this can be better than that, and you get a death benefit. So it's sold as like this all-in-one package that does better than everyone else. So we're going to do a side-by-side comparison today to determine, is that really true, and should we be doing that or not? To just set some guidelines, we aren't going to be looking at net returns. We're going to be looking at gross returns. For those of you that aren't familiar, gross returns is before fees and before taxes. Net returns is after fees and after taxes. The net is the actual dollar amount that gets to you, usable dollars. The gross is just everything that's been accumulated. We haven't taken out the fees and all of the taxes yet. I think it's going to be best for us to do this comparison of VUL, a variable universal life, versus an index universal life. Because a variable universal life can have access to the actual market. So it can have the highest of high and it can experience the losses. But both of them have tax-free environments. But we're not going to look at the actual fee. That way it becomes a really apples to apples comparison. But just think of the VUL like an investable account, because that's what IUL is trying to compare itself against. And we want to have an objective way of confirming whether or not we should make that choice, whether we should put our investable dollars. Remember, we're not comparing cash dollars. Where our cash dollars are stored, our bond dollars are stored. Those should be stored in different accounts. IUL is making the claim that it can be compared to investable dollars instead of cash dollars. And that's where I think it gets off par. But let's look at it so you can make the objective choice on your own. So the way we're going to do this is we're going to look at this over a 40-year period. We'll gather the data of what did the market do over the last 40 years. We did 12.53% average return. So we're going to take this, we're going to copy it and put it into our calculator here. Okay. So we look here and we have the 12.53% rate of return, just like we had inside of the last 40 years. We had 12.53%. Just like we saw, we have lots of positive years with hardly any negative years. Look at all the red there. Okay. That's the market does well. It's 12.53, but an important lesson we need to learn, this is just an important understanding, and average rate of return of 12.53 is not the same thing as the actual rate of return. Notice how it's almost 1.5 points less in actual return. I know today we're not really focused on this, but this is something you need to understand. When someone says average return, know that the actual return is probably less than the average. Actual does not equal average. And it's important to understand that. Now, to compare this, we'll just open up another calculator here. And we'll just see my account that all my investable dollars went into an investing asset, resulted in me getting $6.8 million at the end of that time frame. If I had taken those dollars and instead invested them inside of an index universal life policy, and remember, you should never be thinking invest inside of a life insurance policy. It should be I saved money inside of a life insurance policy, but IULs purport that it's investment-like return inside of it. So let's look at it in that manner. But before we can do that, we have to understand a few things about IULs. We compare in that first example the S&P 500 WIP dividend, but IULs don't actually participate in the market. They're options. The life insurance company is optioning your dollars and trying to get a bigger rate of return. So you don't get dividend returns in that. So we have to use the S&P 500 without dividends in order to make the comparison valid, because you don't get the dividends inside of an IUL policy. And you would get them inside of a VUL or inside of, if you had just invested straight into the S&P 500, you would have gotten the dividends. But inside of IUL, you do not. So we need to change the rates of return. And notice what just happened just with that. Our ROR, our rate of return, dropped from 9.96 to 8.62. Just because we couldn't participate with the dividend, we had a 3% decrease in our outcome just because we couldn't participate in the dividend. So this is the investable account, just going straight to the investments. My average rate of return is 12.53. My actual rate of return is 11.16. But because I'm in an IUL, I don't get to participate with the dividend. So now my average return is 9.96 and my actual return is 8.62. Now, before the IUL people come at me and say, hey, this isn't an actual representation, I know that I'm just trying to go steady and consistent so we can make an objective opinion around this, that maybe or not, we might not be making the right choice. So just look at the dollar amount, 6.8 million inside of the one that goes straight to the investments. Inside of the IUL, I have 2.79 million. Now, one of the biggest selling points of an IUL is that you don't have to participate in the losses of the market. You get loss protection, and that's why people love to buy it. So let's see what happens when we add in the floor of 0. And just for your information, the reason that you have the floor of 0 is because you're actually not participating in the market itself. You're buying options on the market, and if the option fails, the lowest you can go is 0. If the option succeeds, you have a much bigger upside, and we'll talk about that in a little bit in the future. But that's why you have a floor. It's not some magic. It's just that you're actually not on the market, and because you're on the market, you don't get to participate with the dividends. You're just buying options, but that's why you have the floor. So let's add the floor. Now this looks great. This is how they sell the policy. Look at how, because I took away all those negative years, I took away this one and this one, all these purple spots here, because I took away all the negative years, my rate of return went to 12.95, my actual return went to 12.40, and I have $10 million, and I'm outperforming had I just put it in the market and experienced the losses. But the problem with this is that it's not fully true, because yes, you don't have to participate in the losses, but you also have a cap on the upside. You don't get to put in the full amount on the upside either. And because you don't get to participate in the full upside, it has some ramification. Now, the other important thing to remember about caps is that the life insurance company is 100% in control of what the cap is. A few years ago, caps were in the 12-15% range. I even have seen some people had caps in a single year of like 18-20%, but they're slowly dropping, and they're probably going to continue to drop. And it's likely, even no matter what you did, that it'd probably drop anyway. So let's see what happens to the cap. Let's just add a 10% cap. My average yield dropped to 6.5, and my actual yield dropped to 6.41. I had $1.1 million in my account because I had them in. I had the floor, but because I also had the cap, it shrunk my account. And a 10% cap is honestly quite high. Over time, they probably are going to fall somewhere between 7 to 8%. But I mean, 10 is probably pretty normal, we could say. Some people in a single year probably could have a cap of 15, but to have a cap of 15, 20% consistently for an entire 40-year period is not realistic and not probable to happen. So I think 10% is a good spot to sit on. But this isn't the only variable that we have to consider, because they also have something called participation rate. So how fully are you participating in that 10% cap? So if the cap is 10, are you 100% participating? Do you get 100% of the 10%? Or if it's 80% participation, you only get 8%. And look what happens to our yield now. 5.2 and 5.14 with $742,000 in it, if our participation rate is 80. And I know there's ways to lock in participation rates, but again, participation rates also can change. Like you could start out with 110 participation rate and have a little bit better, but just because it's 110 today doesn't mean it's always going to be 110 40 years from now. And so life insurance companies sell IULs heavily. I've experienced is they try and suck people in with really attractive caps and participation rates early, knowing that they're going to pull those down later. So to just keep it really simple, we're going to have a 100% participation rate with a 10% cap. So we have 1.1 million in our account versus if we just sent that 100,000, exposed it to the S&P 500 with dividends directly, I would have $6.8 million in the account. $5 million more inside of my investable account instead of my IUL. I just want to take a quick look at, we're going to do what's called a side-by-side comparison because it can give us really good graphical data. So we'll add these two options. We'll do option 1 and option 2. illustrate for 40 years, current age 40. Okay, and then we'll graph this. And you can see the difference here. The green line is the IUL, which is slow and steady, consistent growth because it doesn't experience the negatives. And then you have the investable account. It has a little bit more rocky ride, but it has a much higher outcome on the backside. Okay, so now the question is, well, what happens if I add premium? Does adding premium change this? So if I'm paying large amounts of money into the life insurance policy or into my investable account, does that change the rate of return? Well, let's just take a look. So let's add a payment. Add payment 1 to this. And let's just say we're going to add $50,000 a year into the policy or into our investable account. We can just easily turn this on and off. So the average yield was 12.53. Didn't change. And the action, when you take it away, when you don't add premium, the actual yield is higher. When you add the premium, the actual rate of return is lower. It's almost 2 points lower when you pay on an annual basis of 50 grand, but you have $33 million in the account. Now let's take the same scenario. Let's just look. We're going to do apples to apples comparisons as best we can here. So let's do 50,000 in premium. Just make sure we add that in. Okay, and let's see what happens. So it doesn't have, the effect is minimal because of the floor and the cap. It really makes the ROR and the rate of return stay pretty much the same. It doesn't really have an effect on it, which is just interesting to know. But now we have $10 million in our account. Let's do the side-by-side comparison again so we can see the difference between the two. So we have if we just put all of our dollars into investable accounts versus if we put the same dollars into an IUL. So this bar graph is the contribution of the 50 grand a year. And you'll notice that again, like the gap is really substantial. We have 10 million inside the index universal life, and we have over 30 million had we just invest the dollars straight up. If I'm going to make the claim that IUL is a 401k replacement or a investable replacement, then I have to compare it to the investment itself. And if you're going to do that, IULs get smashed. It doesn't even, they're not even the same ballpark of difference. In fact, let's look at what is the difference between those two. So let's find what is the percentage difference between our values. So if we have 10,147,707 versus 33,002,920, and we're looking at a difference, it's 225% more money inside of my investment account than I have inside of my IUL. And IULs are sold so aggressively as tax-free income. I'd rather have 33 million and have to pay taxes on it because I'm going to be able to spend a heck of a lot more when I stop working versus having 10 million tax-free. The 225% difference just isn't the same. If you have scenarios you'd like to see me run, write them in the comments. Say, hey, I would like to see what happens if I did X, Y, Z, or if we did this or that. I really want to just compare this with, I would be happy to do that for you. So just put it in the comments what you want to see. If you would disagree with me and you're like, I want to prove you wrong, I'll try and do it. And if I'm proven wrong, I'm proven wrong, and I'll eat my stuff. But to me, objectively, the math doesn't line up with what IULs are selling, because we didn't even incorporate the cost of insurance or the fees that go with having an IUL policy. That's going to drag down the overall rate of return as well. Now there's going to be less cash value in the account. It's going to put people at risk because, for example, I had a client who had an IUL and his fees were six figures or above, because when he got above 65, there's a whole bunch of insurance costs and insurance fees. And I know there's agents who say, well, he didn't have it structured properly. Well, he did. The agent that sold it to him set it up in the way that all the IUL agents that I know that set it up properly set it up. And his fees were outrageous. It would eat his cash value. He was going to run out of cash without ever pulling it out by age 75. We didn't even incorporate that today. Today was just looking at the gross comparison between if I'd taken those investable dollars and putting them into an investment or investment strategies versus taking those investable dollars and putting them into an IUL. It just doesn't come out well. And I can't say it any other way. The math says it's not even close. In our example today, it was 225% more money inside of the investable account than the life insurance. When we're comparing life insurance, we just stop trying to make it something that it's not. Life insurance is supposed to be a cash asset vehicle that gives you cash on hand that's comparable or could be replaceable of your bond and used as an ability to leverage that death benefit in retirement. Because if you know if that death benefit is going to replace your asset, you can spend your other assets differently. You can spend more of them. So instead of you having to distribute on your assets 3 to 4%, according to Dr. Wade Fowle, off of your asset, if you have whole life insurance, for example, you can usually spend 6 to 8% on your asset just because you have this cash flow bridge, this asset class that is cash only, guaranteed, fixed price or fixed fees all the way through, all the way to death. That's guaranteed to be there. That's guaranteed to replace your income. When you view it like that, instead of an investment and try to make it something that it's not and just use it for enhancement of your portfolio versus trying to make it into all these sexy rates of return, that's what it should be used for and seen as. When you start to take it out of what its job is or what it doesn't perform well. It's going to leave a lot of people upset and cause a lot of people heartbreak when they're in their retirement years and they're past all of their high income earning years. Then they're expecting X amount of dollars in retirement income and their policy just isn't producing, or it might even blow up in their face because the fees get so high or it didn't have as much cash value as they were hoping, that it causes people to get really upset at the insurance industry. When if you have the right perspective around what life insurance should be, it fits perfectly in your portfolio. You're not trying to compete for dollars. I have dollars that are going to my cash account and I have dollars that are going to my investment account. When I get to the retirement age, they're going to play really well together and it'll allow me to spend more money in retirement, allow me to still leave a great legacy, and allow me to have the permission to live in abundance all the way into my life versus scarcity. And I believe that IULs cause you to start pushing the scarcity. And to me, the math plays it out. If you disagree with me on the math, please respond in the comments. I'm happy to have conversations, but I can't argue what the math says. We just looked at a 40-year period of time where the outcomes were different, dramatically different over time. I'm Justin Maxwell. I hope this was insightful. Please ask questions if needed, but I look forward to future conversation with you.